Great. Well, it's great to be here. I'm betting of all the speakers tonight, I'm going to be talking about the asset class which is most unpopular. But as Mr. Buffett would say, it's important to be greedy when others are fearful. So there's a lot of fear out there, and I think it's actually good timing to be looking at investing in China. Standard disclaimer. I was asked to give a quick sort of overview of my background. So I've always been focused in Asia, really started in Japan. I started running a portfolio focused on Asia Pacific from 2003, and China has always been a really key part of that. It's a great stock picking market. As you know, it's a market that tends to be very much impacted by headlines, geopolitics, and that sort of thing, whereas on the ground, the companies are getting on with it, creating a lot of value for shareholders. So that can create real opportunity, and I think we're in one of those opportunities right now. In 2014, it's not here, but that's when I took over the trust from Anthony Bolton. So just in terms of the trust itself, obviously a closed-end structure, which as someone who runs open-ended money as well, you really appreciate not having to worry about liquidity. I have a small cap bias, and I really try to leverage a significant team that we have on the ground. So we're looking at a lot of small cap opportunities. So that is something that I really appreciate. You see the gearing in the portfolio. So as I've said, I think now is a time where sentiment is really bad, things are cheap, there's a lot of opportunity. Now's the time for the gearing to be high. So we're definitely at the upper end of gearing from a historical basis. So we're at 20% net gearing. We have the ability to short as well, despite a lot of opportunities and a lot of value out there. There are still some sectors that are struggling, and that creates some short opportunities at the same time. And we can also have up to 15% in unlisted holdings. And the unlisted portion of the portfolio has actually been a pretty big driver of value over time, and a part that I'm actually pretty excited about. And we'll talk about some of the individual holdings. That was 9% as of the end of December. It's a little bit over 10 right now. We've added a new holding quite recently. Just in terms of the key things that I focus on in any individual investment, just to run through really quickly. One is scale. Scale, just thinking about the size of a potential opportunity. How big can a company be in 5, 10, 15 years, given how they're positioned, given the opportunity set ahead of them. Second is returns. You can have a lot of businesses that grow a lot but don't generate great returns. So really thinking about incremental returns on capital, competitive advantage, how sustainable that is. And ideally, those things come together. You've got a company that's generating high incremental returns on capital that they're investing in the growth opportunity ahead of them. Third is management. You can have a great opportunity and a great business, but you need management to execute on the opportunity. So that's a key thing for us. Obviously, we're investing in China. The vast majority of holdings are in private companies. And in general, we find it's the private companies where we're much more aligned with the management team. We don't exclude the SOEs. There can be good value in some of the SOEs, but it's generally the private companies that we tend to focus on. And then finally, tomorrow's gems, as I mentioned, I do have a sort of a mid to small cap bias. So, we're really focused on companies that haven't been identified by the market, early stage, that we think we can, we think have the potential to graduate to be mid and large caps over time. In order to do that, you need a significant team. This is our team in the region. So significant resources. These are analysts that I talk to every day. We would have sort of about 20 or so analysts that are China focused. The majority of them being purely China focused, and they're based in Hong Kong and in Shanghai. So these are the guys that I'm talking to all the time. They'll have an individual sector. Their job is to get their best ideas into the portfolio. So here's the performance over time. As you can see, it's been a pretty wild ride. Investing in China, we have delivered the returns over time, but let's face it, it's been a tough couple of years in the market. Last year was better. Unfortunately, we lagged. Areas of the market that we focused on, the area that I've probably added to the most in the past 12 months has been in the consumer space. That has been an area that's weak, but I think it's an area that's presenting a lot of value. And I'm pretty confident that the holdings that we have there, that value will get recognized over time. Okay, so the investment case. So just kicking off with just overall growth in terms of GDP growth for China. Macro, is always a huge focus. It's, we're very much focused on the individual companies, but we do need to think about the macro backdrop. We wanted to put this chart in just to show you, obviously it's been a volatile time, heavily impacted by COVID. China has taken a different approach, I think, to many of Western economies over that time. They haven't really stimulated coming out of COVID. And growth has been relatively tepid coming out of that, as you can see for 24 and 25. Tepid, but we're talking 5%. 5% in a global context isn't particularly bad. It's probably disappointed. I think the area that's probably disappointed the most is you see household consumption. Consumer confidence has been weak. There's probably a few factors behind that. I think there's concern about employment. With sort of the regulatory crackdown, the reaction, particularly from a lot of the big tech companies, has been to cut costs. Now, incidentally, that's coming through in earnings for the big tech companies now, where they're revising up earnings. But I think those job cuts probably have hurt the general mind of the consumer. By the way, when we talk to the big tech companies now, we think most of those big job cuts are behind us. They're reinvesting, and so I think that's going to be less of a drag going forward. The other factor, which is often most talked about, is the property sector. So we've been through, a pretty tough period in terms of property. If you look at property prices, they're probably down in tier 1 cities, maybe 20, 30%. It's been a tough time for some of the smaller developers. The market itself, it's probably been, maybe 200 basis points of sort of drag on GDP. It's likely to be less of a drag going forward. There's been a pretty significant change in the mindset of regulators from September last year. And, we're definitely in a period of loosening. There was a period of tightening of the property sector. That's, been one factor that's contributed to the adjustment in the sector. But now there's a very much, I think, an increased focus on driving growth in the economy, a recognition of the drag that property has been. And we think there's a good potential for things to stabilize from here. I'll show you a chart on property prices in a moment. But why do I think things can improve from here? Obviously, it's been a weak period for consumption, and so the consumer has been underspending. And you see that coming through in the deposits of the balance sheet of the consumer. So definitely savings are up, debt is down. So the consumer itself is cashed up. We just need confidence to stabilize. And I think it's interesting, you'll find, in many ways, China contrasts with the West, where in many cases you've got a much more extended consumer, high levels of credit card debt, et cetera. In China, it's the opposite. The consumer is cashed up. We just need improving confidence going forward. So under property, it's very early days, but there are some signs of stabilization. So we've got looking at home prices on a month-on-month basis on the left and on a year-on-year basis on the right. So 2 to 3 months does not a trend make, but we've had 2 to 3 months of month-on-month increases in first-tier cities. Signs of things stabilizing. I think the outlook is pretty good given that the actions that government has taken. This is important because obviously, we talked about the improving balance sheet of consumers, but property is still a big part of that. So in my mind, the wealth effect has probably been a drag on the consumer as well. So if things can stabilize, I think that's definitely a positive trend. So definitely something to watch. One thing that I try to express when I'm talking to investors is just the level of innovation that we see happening on the ground in China. It's sometimes hard to express, so we look for charts to try to express that. Here we're just looking at the level of patent activity in China. So if you look at the filings, just under 50% of global filings, and that share has increased over time. R&D spend. So you see how you're looking at total R&D spend there on the left and by sector on the right. So basically, private companies have compounded their R&D spend at about 20% over the last decade. And I think that is really what's feeding into increased competitiveness of companies. And again, I think this is something that's underappreciated. You see companies, you've seen the creation of whole industries. Look at the EV space, electric vehicle space. China, effectively dominates now. But I think a lot of that reflects heavy R&D spend, and that's hurt. That has been obviously a drag on earnings, but we see it coming through in much greater competitiveness of companies on the ground. So onto the sort of that coming through in the numbers. So basically China has gone from number 5 to number 1 in the last 3 years in auto exports. And then you look at the total EV market by country. China's producing over 60% of the world's EVs. And again, I think this is another thing that's underappreciated in terms of the competitiveness, and that's just sheer volume. If you're producing that volume of cars, that is going to it's going to flow through into increased competitiveness. And obviously part of this is coming about because there's so much higher penetration of electric vehicles in China. We're looking at over 50% of new cars are EVs. But just that sheer volume that you're getting in the domestic market is giving companies competitive advantage as they go globally. And we see it across a range of sectors, obviously in autos, but in things like appliances, auto parts, etc. Just that sheer volume, I think, is leading to increased competitiveness of companies. So, when we think about some of the things that are being a drag on the market, obviously geopolitics is a big issue. Tariffs is something that always comes up. President Trump has been talking about 60% tariffs, on imports into China since he ran. So the good news from a market perspective is this is not new news. It's very, very well flagged. But I think it's worth, just stepping back and just looking at, sort of how China has managed this. Obviously, many Chinese companies are already paying 25% tax from the first administration. So the companies are very used to sort of managing this. And what's interesting is that I think through that increased competitiveness, many of the companies that we look at have actually gained share, even as they're paying these higher tariffs. And generally, they're making higher margins internationally than they are domestically. So there's, even with higher tariffs, there's room to absorb that. It's interesting. What are we in day 1, day 2? We didn't have tariffs announced on the first day, so we'll see what happens. But again, from a market perspective, I think it's positive that this is very well flagged. I think another thing that's underappreciated, if you look at the benchmark that I manage to is MSCI China. If you look at the US revenue exposure for the benchmark, it's less than 3%. So the market is hugely focused on exports. The vast majority of companies in the index are domestic focused. Under 3%. In the trust, it's a little bit higher for me because I've actually been adding to names that have that exposure because there's so much fear out there and it's created a lot of opportunity. But still, the vast majority of companies that I'm investing in are focused on the domestic market. So another part of the story is obviously valuation. You can see where the valuations are. We're looking at sort of 9 to 10 times forward earnings, which is about 1 standard deviation off historical averages. Roughly a 60% or so discount to the US in terms of valuation for growth, which is, if you look at sort of forward earnings, is actually not that different. MSCI China forward earnings, you're probably looking at about sort of 10% or so earnings growth. There has been some downward revisions, but this hides what's happening at a sector level. A lot of the revisions have come in property. It's been a very tough time in the property sector. If you look at areas like the technology companies, you've actually seen earnings upgrades. So just looking at China, again, in a global context, in terms of global GDP, you see the US versus China there. So China, about 17% of global GDP. Look at its share of global benchmarks, 3%, versus the US at 67%. Look to the right of that, and you'll see that versus that 3%, people are underweight. So even actual, if you look at sort of exposure of global investors, they're actually underweight versus a very underrepresented market to start with. So again, looking forward, a potential shift in sentiment. I do think there's lots of room for potential flows into China over time, just given how underrepresented it is relative to its place in the world and the world economy. One more thing that I think is underappreciated is what's happening in terms of returns to shareholders. So when we step back and sort of analyze the past few years, what has contributed to the underperformance of China, most Chinese companies have had, they've been significantly investing in the growth of their businesses, so they've been a net issuer of shares. That is starting to change. So you can see, the US has obviously been in sort of net buybacks, but China, really for the first time last year, is actually reducing overall share count. So you're seeing significant amount of buybacks and dividends. I've got a number of names in the portfolio. If you combine dividends and buybacks, we're looking at double-digit type yields. And you can see the trajectory there on the right of payout ratios, which I think is interesting when we compare. Another market that I look at is Japan, and there's a lot of excitement in the market about the amount of capital return that's happening in Japan after many years. But the trajectory in terms of those payouts in China is actually not that different. And by some calculations, the number of buybacks relative to market cap is actually greater in China of late. And again, it's not surprising. Potentially with the slowdown, there's not as much capex opportunity, so there's extra cash. Companies recognize the value in their stock. So they're actually quite happy to be buying back stock and dividends as well. So, I think this is something that's underappreciated. We are in our 14th year for the trust. We've increased dividends every year, and that's coming on the back of the dividends that we're getting from companies. Okay. How much time we got? We're getting there. So I'm not going to go through all of the holdings, but you'll see some of the key names there. Maybe I'll touch on the top one, which is ByteDance, which is obviously very, very topical given everything that's happening with TikTok in the US. This is one we actually added to in the last 12 months. So again, private company, but we're able to add to it. We think we've added to the position at a single-digit forward multiple for the biggest tech company that's growing really strongly in China. Now, what's interesting about when you think about that multiple, that's with international losing money. So, we'll see how things play out with TikTok, but no one is really factoring it into the valuation for this company to start with. The other thing that I think is underappreciated is the rest of the world. So, there's a huge focus on the US, and it's not small. It's 170 million users. It's half the population. That's 1/10 of their global users. So, again, the focus tends to be on the US, but there's actually really, significant opportunity outside of the US. I'd call it optionality. You're not paying for it, but, if there is potential value, recognized there's really significant upside, and that's, I think, an example of, what we own in the private space. Maybe just touching on the next two, because I think they're also sort of good examples of companies in the portfolio as well. Pony AI, leader in autonomous driving in China. That was in the private portfolio. That listed in the US in November, last year. So that's going to be, a huge new market. And again, we think they're the leader in that space. And China, is definitely pushing ahead, with autonomous driving. Hesai, number 3, global leader in LiDAR. So these are somewhat related because in autonomous driving, I think eventually this is going to be a standard component. And we have companies out there like Tesla who say that we can go without LiDAR, but I think we'll in sort of the fullness of time, we'll see all companies move to LiDAR, and these are by far the leader in this space. And again, similar story, leveraging huge domestic volume, extremely price competitive. Sort of another good example of the types of companies that we're investing. Having said that, these are quite growthy companies, but I talked about the overall valuation for the market. The trust itself, we are trading on roughly in line, if not slightly cheaper than the market. So we're probably on 9 to 10 times forward earnings, and we're expecting earnings, when we aggregate earnings for the portfolio, growing close to 20%. So time is up, so I think I'll stop there, and we'll go to questions.
Lovely. Thank you very much indeed, Dale. Now, just to say, Dale's on a flying visit, so after his presentation, he's going to be leaving us tonight. So if you have any questions, this is your chance to get him to ask your questions. So if you have a question, please raise your hand and wait for the microphone to come over. Otherwise, I'll kick things off. Question over here, please. Thanks, Steve.
Good evening. Your predecessor is very keen on China. It's his top pick, I understand. I see that Chinese bonds have performed very well. And is that indicative that the cult of the equity in China is over?
Yeah, obviously it has been a very strong bond market, and that reflects these concerns about growth in the market. When I talk to our fixed income team, it feels like things are somewhat overdone. It sort of, you've got to interpret from that. You're sort of looking at Japan-style deflation for an extended period of time to make the numbers work. But I don't think from the equity side, at least locally on the ground in China, things are dead. There's quite interest in the market. If you look at again when the policies came in, sort of around September last year, there was a really significant increase in the number of new accounts. So all the security companies are talking about an increase in account openings. So equities are under-owned. I do think there's good potential in the domestic market for people to get more interested over time.
The gentleman to your side, please. Thank you.
Thank you. Obviously, the market's cheap and sentiment is sort of on the floor for China. I suppose the question is, what could the catalyst be for that to change?
Right. Yeah, I think it's gradual improvement. So I think things have been getting worse. I think if we're here and it's like, well, hang on, property prices have kind of stabilized. Hang on, the consumption numbers are slowly getting better, and then the market starts to think about, well, there's a lot of potential for that to get a lot better, given the state of the consumer. So in my mind, it's really about just gradual stabilization and improvement. And we have a new government in the US. Okay, despite that, guess what? Companies are still growing earnings. I'm very focused on individual companies and confident on their ability to grow earnings. I think it's just a realization that, hang on, despite all the risks that are out there, the companies are delivering their earnings. They're paying back more to us as shareholders. A lot of the risks are in the price now. Is a decent time to be looking at China.
Question over here, please.
Can you talk a bit about fund flows into and out of China with institutional investors?
Mm-hmm.
I mean, split by international and domestic. Are they putting money in or pulling it out?
Right. So if you remember the chart I had previously, so basically, there was a period where you did have more foreign money coming into China. I think definitely, we're at a stage now where a lot of people have pulled out. So I think a lot of money's come out. I think domestically, again, we're still at a 5% growth rate. Savings are being generated. The domestic mutual fund industry has been relatively strong. You've got to think about, I'm actually quite bullish on insurance. I think insurance has a really good prospects over time. Those assets continue to grow. So institutional domestic ownership of the market, that will continue to grow. And in terms of foreigners moving out of the market, again, my sense is a lot of that has already happened. Yeah.
Another question here, please.
The trust has long traded at a discount to NAV. Recently went out to 15%. What is the discount control policy, and is there any prospect of it changing?
So the policy is targeting a single-digit discount. And after evaluating lots of potential ways to manage that, share buybacks is the main way that we look to close the discount. So we're consistently in the market, pretty much in times like this every day. We bought back just over 4% of outstanding shares last year. And I'd imagine, given the sort of discount that we've traded at year to date, we're in there being pretty active as well.
Have the board set any sort of limit on how much they'll spend on buybacks?
No,
No?
I don't think so. Yeah.
Any other questions, please, for Dale? So, hand up? Or? Yep, yeah.
Are you increasing the gearing to fund the buybacks, or how are you funding the buybacks?
Yeah, so that's something that I have to think about. I'll see cash come out when we're in there, but buying in the market. But as you see, the gearing is already high. But it's sort of 40% of outstanding shares. For me, it's manageable, quite manageable.
A lot of challenges, but to have something more positive. What gets you most excited? What when you're getting into the work in the morning? What gets you still excited about investing in China?
For me, it's the opportunity. It's the risk reward. Seeing great companies trading at great valuations and not being appreciated, and imagining how it could be in 6 to 12 months. If just with some shift in sentiment. So. I love looking at the individual companies and just following their execution. So that's that's the exciting part for me.
Another question I had was, did you go out and see all your portfolio companies?
Yeah.
Are you out on the road?
Yeah, absolutely. And it's interesting, you're talking about sort of getting excited about it. We took the board, the board comes out to China every year, visiting the key holdings. And I think you can ask them, but on the last trip, they probably came out, probably the most bullish they've ever been. You get a lot of again, if you're here and you're opening the FT every day, you're going to get some negative headlines, but you're on the ground actually meeting companies, understanding what they're doing, how they're managing the challenges. It's actually pretty exciting. So yeah, we're on the ground quite a bit.
On that note, I think we'll finish. Thank you very much indeed, Dale.
Great.
Thank you very
Thanks
much.